Hey there, welcome to my live stream, Be the Boss of Your Money. It's a show about money control, you taking control of your money so your money doesn't take control of you. One of the things we're going to talk about today is the stock market is going to have a big week this week. It really doesn't start till tomorrow, but big earnings from the biggest tech companies, a Fed meeting this week, and the unemployment, or I should say the employment figures, non-farm payroll figures come out Friday. So I would say this is definitely the most important week of the year and probably one of the most important weeks of the quarter. A lot rides on it. And is it time to take a little profit? Markets up, hitting highs. More importantly, there were a lot of big cap tech stocks that are up an awful lot in the last year, not just and continuing this year. So do you take a little bit of profit? We'll talk about that as well. We're going to roll a quick intro, throw up the banner here, and then we're just going to talk a couple of minutes about how to think about you specifically taking profits. Here we go. All right, it's a big week because we're going to be hearing from some pretty hefty companies in terms of what they're going to be talking about earnings. Meta, which is Facebook. If you don't know, Facebook is changed your name to Meta, and Facebook is a division of Meta. Alphabet, which is Google, because now Google is a division of Alphabet, a big division of it, but nonetheless a division of Alphabet. Amazon, Microsoft's big numbers. And it's not so much that we're getting a lot of tech earnings in one week. It's that these tech companies represent such a giant part of the stock market. Now, is it time to take profits or not? So let's put a few things aside. I'm going to share with you my opinion. And I think my opinion is a valuable one, right? Our society is much more technology driven. Our economy is much more driven by technology than anything else. It's not really driven so much anymore by manufacturing or banking or energy. We are, for all intents and purposes, a technology driven economy. So it makes sense that the economy would be more widely represented in the stock market. So when people say, "Oh, the big tech stocks are more representative, take up a bigger proportion of the major averages, especially the S&P 500, than ever before," so therefore technology is too high and it's due for a fall. That's a really good way of reasoning if you believe we're going back to the 70s or the 60s or the 50s. But if you believe we're going to stay in 2024 and move forward, then I think it's a terrible way to look at it. Oh, technology's too big. Why? What crystal ball do you have? Well, the last time this happened, technology came back and again became the biggest part of the stock market, and it's the biggest part of the economy, and it's an even bigger part of the economy than it was in the year 2000, which is 24 years ago. You know, the generals are always fighting the last war, as the expression goes. But nonetheless, you have to look at your own personal finance. And we have somebody out there. Just have to say, "Hey, Renee, nice to see you. Hey, Mitch, I'm glad to be tuning in. Thanks for your valuable updates." Thank you very much. Kind words from you, Renee. Thank you. And by the way, guys, when you're watching this, if you have any questions, ask me in the comments. I love hearing from you. It's the best part about doing this. You can tell I get all excited, but more importantly, if you're watching this in the replay, I'll still see your comments. So just if you missed the live and you're watching in the replay, just watch as if you're watching it in the live, and I'll check out your questions. And if you want to know more about me, or if you want to take this conversation about investing and planning to a one-on-one, you can always reach out to me directly. Our website is clientfirststrategy.com. And the information is in the scroll below. Okay. Send me an email or give me a call. So you have to look at things on your own individual basis. Now, for some of you, maybe you gobbled up a lot of tech stocks and you're doing great. And technology stocks, we all know the names, but maybe that does represent a significant portion of your portfolio. And as an individual, you are accountable for worrying for making the decision to have so much in one sector. And if that's the case and that sector goes out of fashion, if it falls, then you're SOL and you could stand to lose a big portion of your portfolio, amongst other reasons. These tech stocks go up and down like any other stocks. They're not a separate asset class. They're just stocks. Now, some of these companies have significant growth. They've shown significant growth. They have forecast significant growth in earnings and revenues. So when you see that P ratio of 20 or 30 or 40, doesn't mean it's high. It means it's reflective of a growth company, which is something that investors like to have. So if you're a growth investor and you're looking for not just growth, but consistent, steady growth from companies with strong balance sheets, well, if those companies are attractive, you can see why the big tech stocks keep going up. But they are up huge. Some of them are up so much. So let's talk about this. Should you sell? In my work as a financial advisor, managing the assets for my clients, okay, I am always looking to make sure that my clients' portfolios are in their best interest, that they're matched to their risk tolerance, their time horizon. I want to make sure that I have money available so that when they have a financial obligation that they're planning for, the money is there in advance. I also want to make sure that if the market does take a tumble and the clients are, let's say, up there in years, I don't want them to be in a position of having to wait a very long time for their portfolio to get back to even. I'm young. Well, I think I'm young. I'm 56. So to me, I have a long way to go. But everyone is different. Some people are 60 and they think they're old. Some people at 60 and they say they've got a long way to go. And then some people want to take more risk because they haven't saved and invested enough during their lifetime. So they want to take a little bit more risk because they think it's going to mean more money for them in 10 or 20 years. It might, or they might be gambling. They might not be taking more risk in a smart way. And that could be a problem for them. So I want to help you avoid that and give you ways to think about this. So without further ado, let's talk about this. You would be advised to have some rules. Like if a stock becomes more than 10% of your overall portfolio, or maybe more than 10% of the account it's in, it should be cut back. Cut back to what? 7%, 5%. Now, when you take profits on a stock, you don't necessarily have to sell all of that stock or exchange traded fund, or mutual fund, or whatever it is. You could sell a portion of it. You don't have to sell it all. Or maybe you say, well, it's just the rate of change. A stock goes up so much so quick that I wouldn't hurt if I took, I put 40,000 into a stock and now it's worth 110,000. Well, if I took $30,000 out of it, maybe that's what I'm going to do. And maybe that's not so scientific or rules based, but at least you're doing something. I think that's more gut feeling than anything, but at least you're doing something. And you don't necessarily have to have a place to put the money. Sometimes you can just put the money into a 6-month T-bill. Sometimes you put it into a money market or the sweep account at your brokerage firm and you leave it there until something better comes along, or something new, a new investment that you want to put money into. Or maybe you buy a bond. There's so many things to do when you have cash, right? Sometimes the biggest problem investors have is that there are too many choices. The paradox of too much choice. When too many choices results and indecision. Maybe you have a rule where if a stock goes up a certain amount, you're going to take a certain amount of the stock in profits. Maybe what you're going to do is sell a little bit of stock and use a trailing stop loss order. So if you put a loss order, for example, 3% below stock, and if the stock goes up, the trailing stop order goes up. Still 3% below where the stock is trading, but as the stock goes up, the stop order goes up. And when the stock comes down, the stop order stays up where it is, and it takes you out. It's another way to add discipline to your portfolio. But the key is there is not going to be a perfect time to sell, and no one is going to tell you when the perfect time to sell is. But if you make your selling decisions based on your rules-based approach to investing, or you make your selling decisions based on your own personal finance needs, you are right whether or not the stock kept going up or the stock went down. And that's the position I want you to be in. You are not a hedge fund manager where you always have to be right and you always have to ride the stock higher or short it and ride it lower. It's not you. You are allowed to take profits in a stock. You're allowed to sit in cash until something better comes along. You're allowed to let your investments, your winners ride as long as you want. You get to do what you want. The problem is you get to do what you want also, which might result in poor decisions. So this is why I always say, ultimately, your sell decisions are not based on how much money you could make going forward. They should be based on your personal finance in terms of how much money you're going to need going forward and when you're going to need that money. I think that's a much better way to make a sell decision than just say, well, the stock is up this much, so maybe I should sell. That's not really strategic. It's more like gut feeling, and it's definitely not a disciplined way to go. And if you don't have that feeling one day, you're not going to sell. If you have the feeling the next day to sell, you're going to sell. And what if you don't have the feeling for a while and the stock goes up and goes down? There are a lot of risks to owning individual stocks. Don't make hanging around too long or allowing a stock to become too big a part of your portfolio become those additional risks. That's what I'm saying. I'm pretty impressed with how the market did today. I'm actually very impressed with how the market did today. You would have thought the market would have come down maybe quite a bit today, but we rose across the board, new record highs. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. The NASDAQ, by the way, was up 172 points, up over 1%. S&P was up 0.75%, and Dow Jones was up 0.6%. So pretty good day. And you know what? There is a lot to like, and the street is feeling very optimistic heading into earnings. For me, if I was looking to take a little bit of profit, and it's buying the news, selling the rumor time, for me, in my opinion, if that's what it is, I don't have to wait. I have stocks that are up for myself, for my clients, and I know which clients I think are the right ones to take some profit now, put some of that cash away into something else. So it really depends on how you want to do it. I know what I'm doing for my clients. And again, if you want to talk about this, you're welcome to call me directly, 631-920-6622. All right, so that is one of the things, new record highs. All right, could it be time to take a few chips off the table? I really appreciate you taking the time to watch this. We'll talk more about selling. I think the trailing stop order for a lot of you is a very intriguing thing. And we can talk about that more also. All right. Oh, just one last thing. With the attack on the U.S. military base in the northeastern corner of Jordan, you know, it would not have been a surprise to see oil go up and the markets go down and the U.S. being further drawn into a regional conflict. But the market just ignored it and went up. And why is that? Inflation figures are coming in. Employment's still holding up. We're actually in a pretty good economy. And with moderating inflation and interest rates starting to come down, that's a really good winning formula for stocks historically. And that's what's playing out now. Now I'm going to wish you a good night. Thanks so much for watching. Have a great night.